Hi guys, welcome back. I hope you guys are practicing all the other learning modules that we've been doing and that you've got no questions but you're getting it right. So I do hope that. Thank you for all the emails that have come through. I hope that I've answered them to your approval. So yeah, but keep practicing and work hard. So now today we will be doing learning module 5, which is inventory systems, and I know you're going to be very grateful, but this is actually not a very long exercise. Now, right up to now, we have been using an inventory system called the Perpetual inventory system. But now imagine you are a cafe owner and you've got 1,000 chappies in a box and you sell one chappie at a time. Are you going to want to how can I say, you want to do a transaction for each and every little chappie that you sell? I don't think, because if you've got 1,000, you're going to have 1,000 entries for trading inventory, which you don't really want to do, and that's just plain too much work. So what they do then is they've got an inventory system that they use, the periodic inventory system. Meaning that cost of sales is not calculated at point of sale. Only after, I think, after a year or after a month, it's after a month, you do a stock take, and that's how you get to your cost of sales. So up to now in the Perpetual inventory system, the cost of sales has been calculated according to, per transaction. As you can remember, that's where we use the magic block at each and every transaction. But using the periodic inventory system, we don't do that. You don't do it at point of sale. Only at the end of the month, when you do a stock take, do you calculate what your cost was for that specific period. So now, just to give you the example or the formula of how to calculate your cost of sale using the periodic inventory system, I will do this here. First of all, remember the previous month, you will have done a stock take, and that closing balance will be your opening balance for the next month. So let's just go here. You've got your opening balance. You've got your opening balance. Then you need to add your purchases. Now that I'm going to explain in a moment. You minus your purchase returns. Minus your purchase returns plus your carriage, railage, excuse my handwriting, and freight on purchases. I'm going to explain the purchases part now. Plus import tariffs, plus your import tariffs, plus custom duties, minus your closing balance. So your closing balance you will get at the end of the month. You will do a stock take and you will add up all the amounts, and that will give you your closing balance, and that will give you your cost of sales. So this closing balance of this month will be the opening balance again of next month. So this is the formula that one will be using to calculate your cost of sales when you use the periodic inventory system. Like I said before, up to now we've been using the Perpetual, and that's how we've been practicing it through learning module 1, 2, 3, and 4. But now we're doing the periodic inventory system. So you've got your opening balance plus your purchases minus your purchase returns plus your carriage, railage, freight on purchases, import tariffs also on purchases, custom duties on purchases, minus your closing balance, which will give you your cost of sales. Great stuff. Okay. now you're asking me, okay, and we are looking at learning example 5a for those who have got the Bookkeeping to Trial Balance SA textbook, the ICB Bookkeeping to Trial Balance. All right. But now you're asking me, okay, Carlo, fine, you explained this now, but what's the difference between the perpetual and the periodic system? Now, as you know, when we did the formula, I mentioned purchases and I mentioned purchase returns. So just to give you a little example, what the difference is let's look at the one illustration. I'm not going to work through the whole exercise because it is quite self-explanatory. So let's just have a look. Okay, it says on day 4, okay, wait. Assume the business made the following purchases of the homogeneous product by check from 2 different. So in other words, they purchased, so cash purchased. So let's just draw our T accounts again. Alright, so draw our T accounts. They say we purchased it cash. So it's bank, which is an asset plus minus. Then we purchase trading inventory, which is also an asset plus minus. And then money went out, so it's VAT input. So now bank will be credited with 4,200. Trading inventory will be trading inventory will be debited with where is it? Oh, sorry. I actually read this thing wrong now. My apologies. It's 4,200. The trading inventory is 4,200. The VAT amount on that will be 588.00, and then the bank would have been debited with a VAT inclusive amount of 4788.00. Okay, sorry about that. I read the top part, but yeah, it was a bit confusing. So anyway, so we bought 4,200 units. The 4,200 will be the VAT exclusive amount and the VAT amount. So in the perpetual inventory system, this is what your transaction would have looked like. Now, the only difference between the perpetual and the periodic system is trading inventory does not exist. They do not have a trading inventory account. In fact, all the trading inventory accounts, they replace with an account purchases. Now, purchases is not an asset. Purchases is an expense account. So in other words, the same debit as what you would have here in your trading inventory account will now become the purchases account in the perpetual inventory system. Okay, so that's the only thing that changes. This is the perpetual inventory system. In the periodic system, trading inventory falls away and all your trading inventory accounts will be changed to purchases. And that's it. So in your cash book payments, in the perpetual, you will have your bank, your VAT input, and your trading inventory, which is an asset. Under the periodic system, you will have your bank, VAT input, and purchases. So that is the only difference. So no matter what you do or where you go, trading inventory falls away, and then the trading inventory account gets replaced with the purchases. But I would just like to give you just a quick warning. What I know in the exams that people love to do is in the exam, if they give you a periodic inventory system that you have to do the journals from, they tell you this is a periodic system. But when they give you the accounts, which you have to put into your journals, they actually, under periodic, they say you have to put in bank, VAT input, trading inventory. So they try to do that to trick you. So you just need to remember when it says periodic and they say purchases, trading inventory, it's not trading inventory. That is purchases. I've seen it many times where they try and trick the people that way. So just remember, trading inventory gets replaced with purchases. So that actually continues all the way here. So in any assume the business purchased goods through, they purchased on credit, it's fine, you will have your creditors control, VAT input, under the perpetual system you will have control, VAT input, trading inventory. Only difference, if you use a periodic, your trading inventory will get replaced with purchases. The same with your creditors allowance journal, except, remember, your creditors allowance journal is when you bought something on credit and now you're returning it. So instead of having the creditors control, under the creditors control perpetual, you will have trading inventory. Under the creditors allowance journal for periodic system, you will have a purchase returns. Now, if you remember our little formula, it is your opening stock plus your purchases minus your purchase returns. So that's where your purchase returns come from. Great stuff. And then another example where you purchase stuff. I think you will remember from learning module, I think it was 3, where you had carriage cost or duty fees on trading inventory that you purchased. We did not create a separate account for the transfer duties and all that stuff. We just added that to trading inventory. Under the perpetual system, you bring it because that'll be included in the cost of the certain product that you will be selling. Under the perpetual, you will have a separate account for carriage, custom duties and import tariffs, because if you remember our example, our formula, you need to add those items because it's your purchases, less your purchase returns, plus the carriage, railage and freight, plus the import tariffs, plus the custom duties. So each one of those items will have a separate account. Okay. And that goes for all of them. Like I said, that's the only difference between the perpetual and the inventory system. Another one, I almost forgot about that. When you look at your cash book receipts, you should know when you do a sale, you remember when we did a sale, you would have bank, sales, bank asset plus minus, okay, sales, money went in, so it's VAT output. It's a liability minus plus. So in other words, money came in, so you would debit bank, it was an income, and you would credit those two. But with that, you remember your column where you had your trading inventory, which is an asset plus minus, where you would credit your trading inventory and you would debit cost of sales. Am I right? Now, under the periodic inventory system, this falls away completely and you only concentrate on this. So because, remember, this is used to calculate your cost of sales at point of transaction, and since in the periodic inventory system you don't need to do that because you will only calculate your cost of sales after a month after you've done a stock take. So that is also something that changes. So your column will your columns will change. Under the perpetual, you will have that cost of sales and trading inventory column in your books. Under the periodic, it will not be there because it is not necessary. Okay, so that is the only thing. The sales and the debtors allowance journal, you will still have your sales and sales returns. Under the perpetual, you will have your cost of sales. Under the periodic, it will not be there because you don't need to calculate that. All right. Are we happy with that? Now I'm going to try something quickly. So I know I've been speaking a lot, but I'm going to just quickly try and just focus on the book. So I'm going to disappear for 2 seconds. And yeah, then just that you can see how I've explained it. Okay, sorry. This might take hopefully not too much time. Okay, and as you can see, there is the formula that we will be using there. So it's your opening trading inventory plus your purchases plus your, less your purchase returns plus your carriage, railage, freight on that plus your import tariffs plus your custom duties, closing balance. All right, closing inventory. Okay. Now just to give you that example, sorry, this is the weirdest thing I've ever done. As you can see there, under the cash book payments, you have your trading inventory, which is the asset. But now just the only thing that changes there is the purchases column, the trading inventory that changes to the purchases column. Okay, and the VAT and everything else is exactly the same. That just changes. Okay, so it's just the trading inventory and the purchases that changes. Okay, in illustration 3, we're looking at the creditors journal, and once again, you have your trading inventory. There, normal, nothing funny there. The only difference in your creditors journal for your periodic inventory system, that changes to purchases. So see, it's and still, where you debited your trading inventory, you still debit your purchases. So I'm just quickly going to go through that like this. I think that will make life a lot easier. Excuse me. Creditors allowance journal. Let me get down a bit closer. There we go. Creditors allowance journal. Once again, you've got your trading inventory. And then there, obviously, your creditors, because that is where you return stuff. So that one changes to purchases returns. And that's in your creditors allowance journal. So as you can see, this is a very easy, you must just remember it, that's all. Now this one, if you can remember, this is your petty cash journal, and here they're talking about you purchased of inventory, paid for transport of carriage and all that stuff. Now under the perpetual system, all those amounts that you see over there is going under trading inventory. You can see they do not make, they don't put all of those things in their own account. So yeah, you paid 1012 for import tariffs, you paid 604 for custom duties and all that. So you must also remember in the perpetual system, as that all falls under trading inventory, But now under the periodic system, each and every one, see, transport custom duties, all of them go into the sundry accounts as a separate account, where under the perpetual it falls under the trading inventory. And there they just go into their own separate account. So you need to remember that. Okay. Okay, now let's get back here. Okay. Now the owner, Mr. Hewitt, took merchandise, and Mr. Hewitt returned goods with a VAT exclusive amount. So under the perpetual system, that would be drawings and trading inventory. Oh, sorry, I'm moving this thing too much. Drawing and trading inventory, and all that changes once again is purchases. So all your trading inventory falls under purchases. See, it's the same account, just the only thing is trading inventory changed to purchases. Cash book receipts, remember that stays the same. We've spoke about that. Cash book receipts is when you sold stuff for cash. So you had your sales, your VAT output, all that's the same, and you have your cost of sales column and cost of sales and trading inventory column. We all remember that. Okay, sorry. So that's just sales that took place. And then under the periodic system, everything looks exactly the same, except there's no cost of sales column. Cash book receipts. Okay, so that all falls away. Isn't that lovely? Debtors journal, periodic, same thing. You've got your cost of sales column. Under the periodic system, everything is exactly the same, except there's no cost of sales column. Okay, this is the debtors allowance journal. Same story. Everything is calculated, sales returns, that all stays the same. You've got your cost of sales column on the perpetual. No cost of sales column under the periodic. So that is, in a nutshell, the only difference between the perpetual and periodic system. Okay. So, under the perpetual system, you would still calculate your trading inventory as such, and you will have your cost of sales column as such. Of course, you will have an account, cost of sales. You will have your trading inventory, you will have your cost of sales. Okay. Under the periodic system, instead of the trading inventory column, you will have a purchases. You see, now all your carriages and stuff under the perpetual system will fall under your trading inventory. But now under the periodic, you will have a separate account for carriage, custom duties, import tariffs, and then you calculate your cost of sales using the formula. So the opening balance, they did give that to us, the 18,000 at the beginning of the exercise. You'll also remember that was a closing balance of your previous trial balance, your stock. It was on your stock previous trial balance of the exercise. The stock was 18,000, so that's your opening balance. Then you take your purchases less your purchase returns, plus your carriage as it was in the exercise, plus your custom duties, plus your import tariffs, less your closing inventory. Okay. And yeah, so there you've calculated that, and that's it. And that is all of it. And if you see your cost of sales total here is exactly the same as the cost of sales in your periodic 22180. And there we go, 22180. Okay, so I think that was actually easy enough. There we go. So that was easy enough. If you have any questions with regards to the perpetual and periodic inventory system, please feel free to email me, send me a message on YouTube. I have to say I'm actually enjoying getting all the messages and helping all you guys out there. I have been getting some requests as well with regards to exercises people would like me to do. So I also want to say on this note, if there is an exercise that you are battling with, please email it to me. Scan it in, email it to me. And yeah, then I'll see when I've got time, and as I go along, then I'll do a movie on that specific questions or that specific exercise. So if it will help you, I would love to do that for you. All right, great, and well, have a good day. I just want to say the next exercise will be learning module 6, which is the individual account for debtors and creditors. All right, so I'm looking forward to it. I'll see you guys next time. Thanks, guys.